Hello, everyone. Welcome back to What's the Rate? I'm your host, Breon Lyons, and this is the Resource Series. Today, I am here with finance coach and former investment banker, Julie Ferguson. Welcome to the show.
Thank you, Breon. Thank you for having me.
Yeah, thank you for being here, and thank you so much for the knowledge that you're about to bestow upon us, financially.
Of course.
Yeah, I know a lot of us indie artists out here, self-funded artists out here, especially in New York City, really need this. Mm-hmm. So, this is definitely, it holds a lot of weight for me and for my viewers. So thank you so much.
Thank you for having me. I'm happy to be here.
Yeah. So I first just want to get into some of the best ways to handle paying off student loan debt. Mm-hmm. So I know I'm not the only one who is dealing with that. But yeah, just give us any systems or practices that you believe would potentially make that easier.
Yeah, that's a great question. I know a lot of people suffer from this, and I know we spoke briefly about this before in our previous conversations. I think the biggest thing I want to lead with is for everyone out there listening, if you have student loan debt, do not look at it like a moral failing. Mm-hmm. A lot of us have it. A lot of us have a lot of different debts of different types, and it's okay. Like, your debt does not define you would be the number one thing I would want to start with. And then when it comes to paying it off, obviously, like, there are technical ways to go about it. Like, you can look at the interest rates, and, you want to pay off the higher interest rates first. But then there's also methodologies where you might want to look at the lowest balance and things like that, which I can get into. But before all that, what I would recommend is deciding if paying off the student loans aggressively is the best thing to do with your money. There's a lot of opportunities out there. There's a lot of different investment types. And you want to make sure when you go to pay off debt that is the highest and best use for your money. Mm-hmm. And so, for example, if your student loan interest rate is 4%, but the average returns on the market is looking like 10, 15, 20%, maybe you don't want to be so aggressive with your payoff and you want to make minimum payments. So I think when you're thinking about paying off debt, especially low interest rate debt like student loans, you want to take that into consideration. Mm-hmm. And then when you've decided, how much you're going to pay toward your student loans on a monthly or regular basis, then I would go to those technical systems on figuring out how to pay those off. And as I mentioned previously, you want to look at the interest rates and the outstanding balances and figure out a cadence that works for you and your budget. Mm-hmm. If you have really high interest rates, maybe some of your loans are private loans and there's like 8%, 9% interest, or even double digits, which I hope not. But if you have these higher interest rate loans, you want to pay those off first, simply because the money that is accruing, the interest that's accruing on those loans is just going to eat away at your nest egg and any type of income you have. Whereas if you have lower interest rate loans, it might not even make sense to pay those off, super aggressively, or, it may make sense to make minimum payments while you put your money in places where it can work harder for you. Okay. So obviously this is a very case-by-case situation. Those are just high-level points, but that's how I would think about it in general.
Okay, for sure. Yeah, I know with the one that I'm really, dealing with right now, it's a private loan. Okay. So that interest rate is a little bit higher. Mm-hmm. But one thing that I've done to try to remedy it is just opening up a high yield savings specifically for that loan. Like, I know with the Ally high yield savings, it's a digital one. You can do different buckets, right? So you can have different mini savings accounts for that entire high yield.
Yeah, that's great.
And putting money aside for that loan specifically, so it builds interest as I am saving. Yeah. So
another thing to consider as well, like, if you're, depending on how big your outstanding balance is and how high your interest rate is, obviously your circumstances are a little bit different now than they were when you were actively in school. Right. So you may even have an opportunity to try and refinance that loan to get a lower interest rate. So something to consider.
I heard that you couldn't.
Really?
That, or they make it really hard for you.
I haven't personally had private student loans, so I've never personally tried to refinance one. But I know it's possible. Actually, my little brother did that with one of his loans. So look into it.
Okay.
And depending on how high it is, you could also, how high your interest rate is, instead of refinancing it into another, well, obviously not a student loan, but you could do a personal loan and pay that off if the interest rate that you qualify for is lower. But that would be also a personal endeavor, seeing, your credit score, your income level, what interest rate other banks or credit unions are willing to give you for a loan. But that could be an option. Obviously, that's going to be more difficult if you're in the double or triple digits with that high interest rate loan, but it's something worth looking into.
Yeah. I didn't even know that was an option. So that's actually kind of makes me like, So next one are some of the best investments that a 20-year-old or freshly graduated college alum can make.
I have some notes here. I'm going to make sure I don't forget anything. But I guess the first thing that I want to mention, obviously, yes, I will go into like the actual investments for your money. But one thing I think that young people can invest in their early days right out of college is, investing in your income potential and your marketability. So it's not a traditional money advice, but investing in skills and building a portfolio of skills that you can really leverage later. So a lot of investing in yourself. And I know you've already done this. You went to undergrad, but you're also building a business and you have a lot of other skills you're developing. I really think that, and it's being proven all around us that, back in, 20, 30, 40 plus years ago, people just got one career and they climbed the ladder. Maybe they would switch companies a few times during their career, or they would stay with the company their whole career. Nowadays, the world is not working like that. And so I'm of the opinion that every person has a portfolio of skills that they're going to have to leverage throughout their entire career and their lives. And so I think the younger you are, the more return on the investment you're going to get by investing in yourself and your skill set, your portfolio of skills, let's say, over the long term. A second thing that I think is a really good investment when you're a young person is your network. The people that you know. The reason I'm on this podcast with you today is because we met, and then I've met more people through you and vice versa. So I think having a good network of people that are in the same or a tangential sort of career path as you, or that you can leverage, just to call them and ask a simple question, or to help get an opportunity or figure out a challenge that you're facing, is also something that's incredibly important. And, the older you get, you tend to just have an existing network and almost take that for granted. And I think building that up when you're young is something that is really important to take the time to do. And then as far as like traditional money investments go, I would say, having the cash buffer, the emergency fund is super important. Okay. Especially if you're creative. With more variable income comes, more uncertainty, especially if you don't have a traditional 9-to-5. So I would say, first of all, have your buffer, like whatever you want to call it, emergency fund, cash buffer, whatever the terminology. But you mentioned your high yield savings account. It sounds like you're on track for that. So would definitely recommend that for everyone listening, especially if you have more variable income, more uncertainty. You might need like a little bit more, let's say, of a buffer. And then finally, yes, the investments. So a Roth IRA is a really good one. You have earned income. It's a really good place to put your money, simply because of the tax advantages with that, but also that account specifically, you eventually sort of like make too much to be able to qualify to invest in that account. I don't remember what it is for 2026. I think it's like $150,000 or $160,000 a year. But if you have, big goals and big dreams to make, millions in your life, if you're making, $50,000, $60,000 a year right now, and you're hoping to not make that forever, you want to get your income higher, you eventually won't qualify for contributing to that account. So it's a really good one to contribute to while you're young. People that have high income do all types of gymnastics. They call it a backdoor Roth IRA in order to get more money into this type of account. So it's kind of, a sought after one that when you're young, a lot of people aren't taking advantage of it because you're not may or may not be thinking of, investing for retirement for the long term. So I think that is like a really good one to put your money in. And then beyond that, obviously, the safer investments, ETFs, traditional taxable brokerage account is great because that's money that you invest it and then you can take it out any time for any reason. Okay. No penalties. It's not retirement related. Yes, it's taxable, so you will be taxed higher than you would on a retirement account, a Roth IRA included. But it is your money to take out whenever you might need it. Mm-hmm. So once you hit sort of your emergency fund, like I have enough in emergency fund, 3 to 6 months of emergencies, saving 3 to 6 months of your expenses in your emergency fund.
Okay, 3 to 6 months.
3 to 6. Well, it's dependent, right? Yeah. So depending on your risk tolerance, depending on like how variable or uncertain your income is, at that point, then maybe you want 6 to 12 months of expenses. It also depends on the economy, right? Like if everyone's getting laid off all around you and you think that might happen to you, then maybe you want 12 to 18 months of expenses in an account. So it all depends. And then and also your comfort level, right? You're just like, I don't, not having money keeps me up at night type of personality, then obviously you want to have a little bit more. But once you have that and you're comfortable with your emergency savings, then you can think about putting money into all of these different accounts. Yeah. And that's what I would say. Also, like, just being consistent is, like, the other thing that I wanted to mention. So, a lot of people have, money struggles, or some people, ignore their finances completely because it just kind of scares them or they don't understand it. Mm-hmm. But with that, I would recommend, trying to be consistent, putting money away a little by little, month after month, instead of, throwing it all in, freaking out, and then trying to pull it out. Just, especially while you're young, like, you have so many good things on your side, like time for your money to grow, for compound interest to take effect, and just build money on top of money while the money is in your account. So my recommendation is start while you're young. Even if it's just a small amount, it can go a really long way.
Yeah. Can we get into ETFs and mutuals and all that? So I just would love for you to break that down and just clarify the difference between like a bond, stock, ETF, funds, and mutual funds and things like that.
Yes, good question. So a stock is essentially a tiny piece of a company. Mm-hmm. When you own a stock, you're owning equity in the company. So let's think of Amazon, right? If you're a shareholder in Amazon has, millions of shares probably at this point. And if you buy one, you own this little teeny tiny part of Amazon. So as a shareholder, you get different benefits, but one of the benefits is you get, dividends if they're a dividend paying stock, and then you get to enjoy the growth of that share. So if one day it's $100 a share and then 3 months from now, it's $105 a share. That $5 is yours to keep, obviously minus taxes, because Uncle Sam always gets their cut. But essentially, you're an owner in that company. A bond is similar to your student loan. It's a debt. So if you're a bond holder, you are lending money to whatever institution, company, public organization that is, borrowing the money from you as the bond holder. And I can go on for days about the different pros and cons and advantages and differences of each, but essentially one advantage to being a bond holder is as tax advantage. So it's like a little bit more favorable when it comes to paying taxes on that. But essentially you are lending money to the company or organization that is the bond holder, that you're lending the money to. So you're the bondholder and the company is borrowing from you, essentially.
Okay. All right.
And then, does that make sense?
Yeah.
Okay. And then there's different things. There's ETFs and index funds and mutual funds. So mutual funds is like the broad bucket.
Okay.
And essentially what these funds do is they're just pulling together little pieces of different investments. So it can be a bunch of stocks or a bunch of bonds or a variety of each. And essentially what that does for you as the holder of that fund, a piece of that fund or share of that fund, is instead of getting that little tiny piece of Amazon, you're getting a little piece of Amazon, a little piece of Facebook, or whatever is in the fund. So essentially,
that's like the S&P 500?
Exactly.
Okay.
So the S&P 500 is an example of an ETF.
Okay.
Yeah. So an ETF is basically a fund or mutual fund that is essentially, it's tracking an index.
Okay.
So those are saying, like, we're going to try to make the returns on this fund match as closely as possible to the S&P 500 or whatever fund or index that it's tracking. The goal of the fund managers is to make the returns on that piece of the fund that you're owning be as close as possible to the returns on the S&P 500 overall.
Okay.
Yeah. So different funds will have different goals, and it could be just to, you know, and there you could get an oil fund and invest in it, and then the goal of that fund might be to just maximize returns investing in the oil industry, for example. It's so an index fund tracks the index, an ETF, exchange traded fund. It's just essentially similar, but it's not tracking an index. It could be anything. It could be like we're going to invest in a specific industry, or we have another specific goal that we have in mind. You basically just have to read, like every time you go to invest in one of these funds, like there'll be a prospectus, and in the prospectus it breaks down, like, in addition to past returns, obviously past returns are not a promise of future returns, but they're usually pretty close. And it also has a breakdown of what exactly we're investing in and what the fund manager's goals are and how well they've been able to reach those goals in the past and all different things like that. And so once you open an account, which can be one of the taxable brokerage accounts or a Roth IRA or your 401k even, you can go in and, well, you have to actually. Once you put the money in there, you need to figure out what funds exactly am I going to be investing in. And the way you'll know that is by researching, like, which ones do I want to put my money in. And that brings me to target date funds, which is an easy way for you when it comes to your retirement accounts to say, okay, I'm going to retire in, I don't know, I think mine is set for 2060, right? So if I'm going to try to retire in 2060, the fund manager of that target date fund will adjust the investments within the fund over time to get to a specific target for my age. Sort of investment theory is that, look, when you're young, you have, you know, you can be aggressive. You have time to take risks. And so essentially that's similar with your life and your career, but also with your investments. And so what is typically recommended is when you're young, put your money in a more risky asset. You have the luxury of putting your money in a more risky asset if you feel comfortable with that. And so you would have more of your money invested in stocks, because stocks just tend to be more risky because, you know, the company can go under at any moment, right? I'm hoping it doesn't, and you invest in a bunch of different ones for that reason so that all your eggs aren't in one basket, so to speak. But when you're young, you have these more aggressive assets. And then as you age, you don't really have the time to make up any losses that you might encounter if you're being super risky with your portfolio. So what fund managers tend to do is, like, as people get older and closer to retirement age, they want to stable out the portfolio a bit. So they'll invest in things that are more stable and secure, like bonds, for example. So when you're young, you have a larger proportion of your investments in stocks. As you get older, more stable securities like bonds and just cash and other things like that. So when you have a target date fund, the fund manager will auto adjust your investments accordingly. So that way, hopefully, you don't just up and lose all your money one day because you're invested in a lot of these risky things.
Okay. Can we get into insurance? if there's any insurance that we should be prioritizing right now. I don't know if that's a useful question.
Yes, that's a great question. I actually just made a video about this on my YouTube.
Okay, yeah. Wait, can we plug that real quick? Please put that.
Yes. If you guys want to hear me talk more about finances, Positive Money Project is my YouTube channel. Would love if you guys checked it out and liked and subscribed. Shameless plug. Yeah. But yeah, I just made a video about this recently. A really big problem is, you know, people being either underinsured or overinsured. Underinsured meaning, you know, there's insurance that you just should have. Like in the US, health insurance is a big one because, you know, something happens to you, you could suddenly have $100,000 medical bill and it's like, what? And that can be detrimental to your financial future. And then another problem, I guess, on the opposite side of that is people being overinsured, having too much insurance. Like you have, you know, term life insurance, and then you got a whole life insurance policy, and then your job is providing you health life insurance, and you don't even have a family. It's just you. And it's like, that's unnecessary, you know? So I guess I'll speak to young people who are just starting out specifically, medical insurance, you know, whether that's a private medical insurer, you're still on your parents, or you're going through the, the marketplace. Figure out how to get medical insurance, just at least the bare minimum. And then if you do have medical insurance, if you're lucky enough to have a good plan through your company, there is another account that I want to mention here, which is a health savings account.
I read about that.
It's a really good one. If you qualify for it, there's certain stipulations for different medical or health insurance plans qualifying for it. The old rule was that it had to be a high deductible health insurance plan. I'm pretty sure that rule just changed. I haven't read into it yet, but it may be opening up to other plans, not just the high deductible plan. So if so, that's really great news. But essentially, it's a really great account because it's triple tax advantaged. And what I mean is you can put your money in there tax-free, it grows tax-free, and you can withdraw it tax-free.
Oh, okay.
And yeah, it's just a really good account to have. And, you know, the older you get, the more, you know, you're going to need to go to the doctor. So even if you're putting like the bare minimum in there, I recommend maxing it out. And sometimes your employer will do like, you know, incentives for you to do that. But, you know, check it out. If you're eligible for it, consider it because it's a really good place to grow your money. And then in addition to health insurance, I would say renter's insurance is a good one to have. You know, most young people are renting if they're not living with their parents. And even if you are, like, I don't know if your parents own and have like homeowners insurance, but if not, renter's insurance is great to get and to encourage your parents to get as well if you're still living with them. It just protects your assets. Like you have a $2,000 MacBook and, you know, I don't know, studio equipment or, you know, whatever you have in your house, TV, clothes, expensive handbags a lot of people have, you know, renter's insurance will cover a lot of that in case of anything going wrong. A flood, a fire, someone breaking in, stealing your stuff, depending on your policy. But it just protects your like everyday items that as a young person, it's not super easy to replace when you are, you know, don't have that much, you know, discretionary income to begin with.
How do you go about getting renter's insurance?
Oh, you can get this from a lot of companies offer it. I think so. I use USAA, but there's also like Lemonade is a really popular one that offers it. I'm not sure how great their plans are nowadays. I haven't looked into that in a while, but you could just Google like renters insurance, like best renters insurance companies, and you can see reviews of them. But it's really cheap too. Like depending on how much you're insuring, it can be like $10 a month.
Oh, okay.
And it protects all your stuff.
All your stuff.
Yeah.
I did not know about
expensive
that.
mattress that you might buy or whatever, like your furniture. Yeah, it's really important to have. And a lot of apartment buildings, especially in New York City, require it nowadays. Like you can't live here unless you have renter's insurance. And you have to show proof that you have a policy in place. Just to protect them as well, because I don't want you trying to sue them because your stuff got ruined in like a flood or whatnot.
Wow, so ironic because my building, they didn't require that.
Oh, no.
And that building has had so much flooding, like terrible flooding.
Oh, did you? I hope you didn't lose any of your stuff.
No. It wasn't while I was there. It was actually the year before. But this is so good to know.
Is this where you're currently living? Oh, yeah, I would get that.
And also going back to like MacBooks and things like that, and also equipment. And I'm just thinking about for other artists who have like music equipment, instruments, and things like that, or like camera equipment, you know, for my photographers out there.
100%.
It covers all of that.
Yeah.
Wow. So do you have to plug in what it is that you want covered by it, or how does that?
I'm trying to remember. I don't think so. Okay. I think it probably depends on the company and their own like specific application.
Yeah.
And you definitely read the terms and conditions because you know, maybe not everything will be covered. But for mine, I just plugged in like the total value of all of my belongings and how much coverage I wanted, and it calculated sort of like the monthly payment based on that. And I've had renter's insurance pretty much forever. And I never had to use it, but you know, you never know. Because if a flood or something like that happens, like my boyfriend, for example, had to use his. He was living in a basement and the unit flooded and all his stuff, like half his furniture was ruined. So, and a lot of his clothes were ruined and he used it. And he was able to get a lot of money from that. So, to replace all the things that got ruined. So, I guess I wanted to go back to the life insurance thing.
Okay, yeah.
A lot of people will say, oh, should I get a whole life policy or should I get term life insurance? I would say if no one is if you don't have like a ton of outstanding debts that you're going to be leaving to someone, or you don't have a family relying on your income, when you're young, if your company is offering life insurance, get it for sure. But if you're young and no one's depending on your income, then I would say maybe you don't need it. If you want it, then get a term life policy, a reasonably priced term life policy. In my experience, whole life policies are just not worth the cost. A lot of people will get tied up in like, you know, I pay $50 a month for 1,000 years. And then when I, you know, pass away, I can pull this money out for my family. And like, they've just been shown that there's a lot of scams tied up with those. So do your homework before you purchase a whole life insurance policy. And this is coming from someone who in my early days worked for an insurance company when I was in college. So just be careful with that. But obviously if you have dependents, you have people relying on you, even if you're dependent on your children or your parents, definitely have life insurance because if your income goes away, you know, or even a spouse, right, who maybe you're living with and they're going to be, you know, you're paying half the mortgage and if something happens to you, they can no longer pay the bills, then definitely a whole life or a life insurance policy is crucial.
You talked about having like the emergency fund, or I like to call it the oh shit fund.
Yeah, the oh shit. That's good. Yeah, that's a good one.
I will ask you, what's the best tax setup that you recommend for independent artists, or how much do you recommend setting aside for taxes?
Yeah, this is a good question. One of my really good friends is actually a tax advisor. Okay. There's an episode with me and him also on my YouTube channel. Shameless plug.
I will link it. I will link it.
Yeah, he's great. But I asked him this question as well. So if you're building a business and you're self-employed, and your income is relatively low or non-existent, then you want to be like a sole proprietor or a single member LLC. Okay. Simply because eventually, like becoming an S corp is great for tax purposes, but there's trade-offs. There's different reporting requirements that the government enforces when you have an S corporation, and you if you're not making above a certain amount of income from your company, the requirements are so like arduous and expensive that they're probably not worth the trade-off. And this depends on your state, obviously, and the different laws surrounding these different business types in different states. But in general, what I've been told is, you know, when I was starting my business, is start out as a single member LLC, and then once you're making above $60,000 to $75,000 a year, the trade-offs become the money that you're going to save in taxes become worth any additional like reporting requirements or tax requirements that are required by the government for having that type of organization set up. So that's what I would recommend, starting off as a single member LLC, but definitely keeping your business separate from your personal. And the reason for that is for the tax advantages. You also can open a solo 401k as a business owner. So even if you're let's say you're making like $30,000 a year from your business, you can take some of that money and put it into a 401k for yourself. as a business owner, which I recommend if you can swing it. Because, you know, as mentioned before, like time value of money, ability for your to get those market gains and compound interest. So those are things to consider. But then definitely keeping things separate for just tax reporting purposes, for legitimacy purposes. And if you're trying to prove, you know, I know you had a question about the write-offs and things like that. If you're trying to like keep track of that and prove, you know, here are the expenses I use for my business specifically, so much easier. So setting up like a business bank account and getting all that in order. This is my first year filing taxes with my my single member LLC, and I should have done a better job, let's just say. So like my own personal lesson learned is even though I know all this, I'm like looking back like, oh, I should have opened that business bank account a couple months sooner, because now I'm trying to like untangle things and it's annoying. But yeah, keeping things separate, keep being diligent about it. And if you're making losses in your business, then you'll have like the proof to say, hey, I spent all this money trying to build the business and build the brand, and I made, you know, way less than I spent. And then you have a loss, which saves you money in taxes. If you have a job, a 9-to-5, and then you have a business that's losing money, that can save you money on your taxes as a whole. So, yeah.
This is so good to know.
Yeah. And then, I think the other part of your question was like, how often should you keep track? So my tax advisor, he recommended quarterly, looking at things quarterly, like how much you made, how much do I need to set aside in taxes, and just keeping that money separate for taxes. And you can even do a quarterly filing if you wanted to work with like your tax person or your CPA to do a quarterly filing. You can do that as well. I'm always a big fan of like saving up any money you think you're gonna owe Uncle Sam.
I have a bucket for taxes in my high yields.
That's great. Yeah.
I don't need Uncle Sam at my door.
Yes. So whatever works for you. But like, yeah, when you have that bucket for taxes, it's like it's in your account and it's earning interest for you in the meantime. And then if Uncle Sam comes knocking, you got what you need to put it in there. But it's earning interest in the meantime. So I'm a big fan of that. But money is personal, and some people would just rather be like, I know if I keep this money, I'm going to spend it, so let me just get it out the door. So you can do a quarterly filing, which is what my tax advisor recommended. So
yeah, to keep everything also like up to date and like, you know what I mean? Yeah, I honestly might start doing that just to like give me some peace of mind, because I don't like just like guessing and like no.
But it's also more work, right? So if you're trying to file quarterly, it's like so trade-offs, right? Pros and cons. But whatever works best for you personally. I would just do your best to try to keep things separate and then save up just in case.
Yeah, for sure. I'm trying to think just like creatively, like just thinking about just like the indie artists, like when it comes to taxes. Can you just like clarify or untangle that if you get what I'm trying to present to you? Where like if you do like a gig and it's like $1,000 or something like that, right?
Depends on how you're
for like freelance work.
Yeah, it depends on how you're getting paid, right? Are you being paid as an employee with a W-2? Or are you being paid as an independent contractor with a 1099? Okay. And so it's I don't want to say always, but in my personal experience, a 1099 is better. Because it's going through your business. So it's not money you've earned, it's money your business has earned. And then from that, if you can take dividends or you can take a salary from your business. But if it's a 1099, it's going into your business, and that money can just stay there. If it never comes to you, then it wasn't earned by you, it was earned by your business. As a single member LLC, yes, it's still going to count against you. It's going to go toward your taxable income at the end of the year. But once you become like an S corporation, then that money won't count as your personal income unless you pay it to yourself as a salary.
Right. Okay.
So that's why people like tend to want to get to the point where they're either like a non-single member LLC or an S corporation, so that they can then determine like, am I taking this as a salary or am I leaving it there in the business? And so that, that gets a little bit more complicated because you're essentially lowering your own personal income by leaving money in your business. But if you don't have any income in the business to begin, like if you're just starting out and your income is really low, it's a lot simpler and almost not worth it, as I mentioned before, to separate that out. Because you're going to need that money anyway.
Right. Yeah,
So that's sort of the difference with that. Does that answer your question?
Yeah, it does.
Okay.
Yeah, because now I'm thinking about, like, as a creative, like, being an actor, the actor Breon Lyons, 1099,
yes,
right? And then Brianna Gotham, that's my W-2s and things like that, because I'm employed.
Exactly. Or do you have, like a business set up for your acting right now?
No.
Okay.
I do not.
Okay.
No. But should I?
I mean,
as a
I would, but
okay.
Yeah, because it can be your single member LLC. And you can be a sole proprietor of that business, and then that money can go through that the income you earn from that can go through that business. And then you can set up a separate tax return, and then you can be able to write off everything you need to write off.
So much stuff. Wait, okay. This is all starting to click for me. Wow. Because now I'm understanding why because the reason why this is such a light bulb moment for me is because just like the tiny like tidbits that I've picked up along my journey of people who have like said like, oh yeah, make sure you always do a 1099, or like this is why, like, or like people who even have like business emails, but it's their name. It's because they have themselves as a business, right? So it's like now I'm putting all those puzzle pieces together right now, and I'm like, oh, okay, now I understand why they were doing that. Okay. Wow.
And then I don't know, like, and obviously this all it goes to show, but like one of the other benefits, and I think I mentioned this before, when it comes to like saving for yourself, right? Like dividends from a business are taxed differently than income. They're taxed lower than income. So that's one big thing. And then another thing is the solo 401k. That you can set up for yourself coming from your business. So there's like a lot of different, and then there's other tax benefits for businesses, but yeah, that's why people do it.
Okay, let's get into some non-financial habits that influence our financial habits.
Good question.
It's a lot.
You know, they always say, like, you are the average of all the people that you spend time with.
I knew you were going to get social. Because New York City, everybody likes to go out to the bars and things like that and splurge.
Which is great. I am not a fan. Yes, I'm a money coach, but I am not a fan of, scrimping and saving and being, like, super minimalist to the point where you're not even enjoying your life. I heard about this person that like worked for like 10 years straight and then retired in their early 40s, and like they didn't do anything. I don't know if you've heard, like my friend was telling me about this other money influencer guy who did that, and he essentially was saving 150% of his salary for like a decade. And I'm like, that sounds really sad. Actually, because you're not like enjoying, I mean, yes, if you can like save 150% of your salary and still like have fun and go to the bar with your friends sometimes, great. But he wasn't. He was just so bare bones minimalist that he wasn't enjoying life. And to me, that's that wouldn't be sustainable for me. Because just, life is too short. Yes, you want to be responsible with your money and have, savings for later, but also have fun, right? Yeah. But that being said, yeah, I think you're going to be sort of an average of all the people that you socialize with and spend the most time with. So for every reason, including money, choose wisely. If your friends are, like spending thousands of dollars every weekend partying or traveling or doing whatever, then you're probably going to be influenced to spend more. If your friends are like super dirt cheap and don't want to leave their house, then you're probably going to spend less, but it might not be as fun. So, I would say find a balance. And, also your own habits, right? Yes, you get a lot of those from the people around you, but also like from your family and how you grew up. Like, what are your habits day in and day out? If you're not conscious about spending on a day-to-day basis, you are going to have a tendency to just spend more because you're not thinking about it. And people, a lot of people who come from money have this tendency, their sort of barometer for what's a lot of money is a lot higher than someone who didn't come from money. And so, someone tells them, oh, dinner's $400. They're like, okay. Yeah, other people are like, $400, I'm going to pass out in my chair. So all those types of things matter. So, but just being conscious, I would say, like, thinking about it, I'm not saying think about your money 24/7, but, have like a little habit where you check your credit card statements once a week and ask yourself, how am I doing? And just be conscious of those types of things. And then I don't know. I think people also who don't like waste, like people who are sort of more minimalist, quote unquote, in life, like they don't want to waste things. They don't, they like to reduce, reuse, recycle. That tends to go hand in hand with also saving money. And it might just be because, you're environmentally conscious or, don't want to like sort of waste a lot and do like fast fashion and things like that. If you're conscious of those things, I think you tend to also like lean toward you're saving a little bit of money, at least in that area, because you might have other reasons for not buying a lot of material things. It might be, other values that you have, but it can result in you saving money in that area.
Yeah.
And that's just one example. That can be like different things, right? I'm too scared to drive a car. I'm never going to buy one. Now you're saving money on a car.
Yeah.
So I think there's a lot. I mean, money sort of touches every aspect of our lives. So I think everything influences your spending patterns.
Yeah.
But if you're trying to improve your spending patterns, I think it's just being conscious of it and looking at who you're spending your time with.
Yeah. And also I would say your values and like what you want out of life and the type of lifestyle you want to have.
Yeah, definitely.
That you want to have and that you're currently living. You know what I mean? I read I Will Teach You How to Be Rich.
Yay!
And some of the things that he talks about is like plan out your year. Like if you want to focus on going on a bunch of trips, okay, plan those 3 or 4 trips, right? Now you need to figure out how to get that bag in order to do that, right?
Yeah.
And just like, so that way it's not like, oh, damn, like I wish I was making $100K a year so I could be going to Paris every summer, and it's like, you can make that happen. You just have to set up the financial system in order to support that lifestyle.
Exactly.
And not only that, but going back to what you were saying about recycling or like making certain sacrifices in certain financial pockets in order to supplement and pour into other financial pockets. Like for me specifically, I don't travel a lot, unfortunately. I do have my passport, but I wish I was able to travel every summer. But I invest in like my singing lessons, my voice lessons, my acting lessons, my instruments and things like that, my DAWs, I wish I had the income to do it all, but just understanding my lifestyle right now. And then also setting up financial systems in order to have the lifestyle I want. You know what I mean? So like investing now and,
Great points. Yeah. And 100%. Couldn't have said it better myself. I love that book.
Yes.
And I think Ramit, the author of I Will Teach You to Be Rich, is spot on. Like you can't just be like spending a ton of money in every single area. Like you can't have every designer bag, go on every trip, have every instrument, go to every singing lesson, eat out every day. I mean, like, yes, if you're a trust fund child with unlimited funds, you can. But most of us are not. So yeah, you have to pick your, sort of your joy, right? Like, what am I going to spend money on? What's important to me? Like, I have friends who like scrimp and save, never go out to eat. I'm like, going out to eat is one of the joys of my life.
I know.
I will never
love
not.
it. Yeah.
Yes, if I'm trying to save money, maybe I'll go out once a week instead of 3 times a week, but it's something that will always be done in my life.
Yes.
But that being said, I don't own any designer handbags, so that's my trade-off.
Yeah.
But whatever is important to you, I have friends who meal prep and eat at home every day and have like 100 designer handbags, but that works for them. So yeah, just have your, your budget, your plan. And if you want to go on a trip next year, maybe you take fewer singing lessons. If it's not that important to you, then keep singing, girl.
Yeah. Yeah. I also just love the way he like spells it out in that book. Like it truly is foolproof.
It's a good book. It's a good book.
Especially how he breaks down debt and also credit cards and the benefit of credit cards.
Yes.
See, because in my household, I was always taught that credit cards were taboo. You do not use credit cards.
Yes.
But turns out actually credit cards can not only increase your credit score, but also there's just so many perks and benefits, whether it be cash back or travel rewards. You know what I mean? So.
Yeah, I was taught the same thing growing up. My mom had a bad experience with like a store credit card.
Yes.
Store credit cards, by the way, would not recommend.
And they run your credit.
They do run your credit.
They run your credit.
Yeah. So she had one bad experience, like I think in her 20s, and so she was anti-credit card, and so that's what I grew up learning as well. Yeah. And I think a little bit about my background, but I joined the military when I was really young, and luckily they forced me to open up a checking account and a retirement account. But one thing they recommended was like, oh, with your checking account you get this like credit card, and I'm like, I don't know about that. And one of the advisors there was like really like, this is good for your credit, and explained it to me at a young age, which helped build my credit. But a lot of people don't know that and don't get that. So yeah, it's a really important thing, and the book explains it well. I think a lot of people are scared of credit cards because if misused, they can be detrimental to your financial future. They can ruin your credit score. They can put you in a ton of debt. And the interest rates on those things are astronomical. So if used inappropriately, they can be dangerous. But if used properly, yeah, they can really benefit you. And, you know, if you get a travel card, you can even take a trip without sacrificing any of your singing lessons.
Yeah.
So a lot of different cards have a lot of different benefits. And yeah, if you can learn how to leverage them appropriately, it can be really huge help financially. There's this thing called credit utilization. So when you have more credit, so you have like 10,000 on this card, 10,000 on this card, 10,000 on that card, or all on one card. I don't know that there's a benefit to having, you know, different cards with a limit, but at the higher your credit limit, the amount that you could possibly spend in relation to the outstanding balance. So let's say you only owe $100. Owing $100 and having $30,000 of possible credit looks really good for your credit score, and it boosts your credit score. Versus if you have $30,000 of possible credit and you have $20,000 outstanding, then your credit score will drop because your credit utilization, it's called, that ratio is too high. And the credit bureaus will penalize you for that because it kind of just looks like, oh, the more credit we give you, the more credit you're going to use. And we want you to have the credit, but we don't want you to use all of it because then that looks like you are just putting everything on a credit card and being irresponsible. Yeah. So another important thing to look out for. Don't do that. And then also if you've got that much outstanding, you know, that your balance is that, your outstanding balance is that big, then you probably can't pay it off by the end of the month and you're going to face those ginormous interest charges, which you don't want.
Yeah. I would love for you to speak to using credit cards to pay off debt and also having auto pay for bills and things like that on a credit card.
Yeah. So using credit cards to pay off debt. In general, I would not recommend this, but there can be instances where it might make sense. So a lot of cards sometimes will have intro offers where it's like, 0% interest for 6 months if you do a balance transfer or something like that. Or if you spend X dollars on this card within 6 months or however many months, we'll charge you no interest. So there's different like introductory things that cards will do. And in that case, if you want to pay off your debt using the card and then, you know, have that 0% interest introductory offer for those however many months, then great, but you have to make sure you pay the debt off, right? So in that case, it could make sense, but I think it's a little risky because if you sort of have the money to pay off your debt in the next however many months, why don't you just pay it off? Yeah. And what could happen is, let's say you have this personal loan, let's say for 10% interest, and you get this card that 0% interest for the first 90 days. Or 6 months. Let's stick to 6 months since I mentioned that already. And then you take that card, pay off your debt, and then all of a sudden something happens in your life and you don't have the money to pay off the card within that 6 month. And then you are now facing this credit card bill with all this debt and your interest rate on your credit card is like 20%. Then you just doubled your interest rate for a debt that you now can't pay off because you used the money. An emergency occurred or whatever in your life. So it's risky. If you can do it, you can swing it. It could make sense, but just be careful, I would say. You could also, I think a better thing to do in a situation like that is like talk to your financial institution. Try to get, you know, I've been making on-time payments for the past 2 years. Can you reduce my interest rate? They could say no, but you could also be like, but I'm a good customer and I want you to, and why not? I'll look at other finance, you know, you can play some hardball to try to get the rate down. I don't know, that might be a better use of your time. Unless you know yourself, you can guarantee you could like stick to your plan and make it happen, then maybe. And what was your other question?
I forgot. We were just talking about.
I know I talk a lot.
No, it's all good. We were just talking about paying off debt with credit cards and if you agree or disagree, but.
That's
seems like it's not the move.
I don't know. People do it. You could do it.
Yeah.
But I don't know. Like a lot of like it depends on what the interest rate of the debt is, right? So if it's like usually like a loan is going to be a lower interest rate than a credit card. So for me, it's like, why would you do that?
Yeah.
I think an important thing is like automating things, like having a money system that works for you, like your personality, your norms in your life. And you know, if you get paid every 2 weeks, then have like a system that works around that. If you don't know when you're getting paid and you might get paid this month and you might not because of the type of businesses you have, set up a money system that works with that. And then automate things, you know, like I think about money every single day because I love it. It's my passion, it's my job, and it's my hobby. And I love teaching people about money, but a lot of people don't want to think about money every day. Money gives a lot of people anxiety.
Because it kind of determines your quality of life. And then like some people don't want to deal with that reality of like, ooh, shit is not as sweet as I thought it was. You know what I mean? Like, oh.
If you are, you know, if you're having a panic attack and getting hives when you look at your bank account, slide into my DMs.
Yes, the Positive Money Project. Yes.
But yeah, so money is a touchy subject for a lot of people. And a lot of people avoid it. For many different reasons, including the ones you mentioned. And so a lot of people don't want to think about it. But if you set up systems behind the scenes, you take the time, face your reality, set up systems behind the scenes that work for you when you're not in the mood to think about it, or you don't want to think about it, or you know it's not going as well as you hoped, but the systems are functioning in the background. It's like, okay, I got my automated money going to my high yield savings, got my automated money going to my 401k, et cetera, to my student loan bill, whatever. It's like, okay, you don't have to think about that. And I don't know, for me, like the money that goes to my mortgage every month isn't as painful when it just comes out on its own and I don't have to write a check. I'm like, I know I have to have money in my account for that, but I don't have to see it go every month. And you just set up those systems that work for you, and it just will help you in the long run because you're saving money and you're not even, and you look at your savings account, oh, I haven't looked at my savings account in 2 months, and you take a look and you're like, oh my goodness, I got money. Yeah. So it could be a positive thing as well. So yeah, those are the things I would say.
So emergency, high yields, Roth IRA, checking, and investment account / brokerage account.
So I would recommend putting your emergency fund into a high yield savings account.
Oh, okay, yeah.
Right?
That makes sense.
So because like you need that money easily accessible in case something, you're, oh shit, right? Oh shit. You need that money pretty easily accessible. So put that in there so you can get high interest, you know, high returns on that. Obviously you need a checking account. I don't know, like for some people it works, some people it doesn't. I have 2 checking accounts. I have one checking account that's linked to like paying off my credit card and my Venmo account. And I have a main checking account where my mortgage comes out of, all the like super important things come out of. So my paycheck will go in there, or any money I make now that I'm a business owner goes in there. And then my mortgage, things like that come out of that account. And then my other checking account, I transfer like my fund money to. Okay. That way, when I look at my checking account to see how much money I have, I'm not looking at my responsible adult checking account. I'm looking at my fun account. Fun money, yes. Yeah, it's like, oh, I want to go on a trip. Do I have money? I look at that account and say, oh, yeah, I got money. Let's do. Or go to dinner. Like if I have a trip, then I have a special savings account for that, like you mentioned. So it depends on how you want to set it up, how complicated you want to be, what's going to work for you. But a checking account, a high yield savings account for your emergency fund. I need a retirement account. So if you have a 401k through your job or through your business, and then you can do your Roth IRA. You can also do a traditional IRA, but have a retirement account. There's a few different types. I can dive into that more, but let's answer one question at a time, I guess. So your retirement accounts, and then your brokerage account, which is a taxable account, which means it's not like retirement savings type money, but it's also money that you're putting in investments that you can take that money out at any time. And you're going to pay capital gains on that when you take it out, obviously, but it's good if you know you're saving for a specific reason that's like 3 to 6 months away or more. And you know your high yield savings account is sort of at a level that you want it to be. Like I've got my 6 months worth of expenses saved in my high yield savings account. Now you can start putting money into the brokerage account because you need money in the next 6 months. You can take it out of there sort of thing. And then you have this money that's growing for you behind the scenes. A lot of people will use a taxable brokerage account to save for like a mortgage, for example, or a wedding. Invest that money because that money has time to grow. I mean, unless you're getting married in 3 months, then don't do that. But that money has time to grow for you and earn higher like returns for you than high yield savings. Because high yield savings is like single digit, depending on the interest rates, single digit interest rates. Mm-hmm. Your investment account, hopefully, if you're doing it right, is going to get you double digit returns.
Now let's talk about some of the expenses that can realistically be written off for artists, and what are the things that people think that they can write off but realistically cannot, or vice versa.
Good question.
So like I'm thinking like Uber rides to set, can that be written off? Or like, I don't know, if you like buy a light off of Amazon for a photo shoot, can that also be written off?
Yep, good question. So the rule here is generally if it's ordinary, necessary, and directly related to your business, then you can write it off. Mm-hmm. You can try writing off anything, but you might get audited. Mm-hmm. So the way I would think about it is, if you didn't have the business, would you still buy it? If yes, then you probably can't write it off. If no, if it's like business specific, then you can.
Yeah.
So yeah, like instruments, if you're a musician, 100%. Mm-hmm. Uber rides to set, I think so. I would try to write that off, but I'm not a tax advisor. Talk to your CPA. I would try to write that off because I would not be going to that place if I didn't, I weren't producing a service for my business. Mm-hmm. And then a lot of people want to write off clothing. I think like, if you are like an actor and you need this clothing specifically for this gig, then yes, I think it can kind of get blurry and might get flagged if you're just like buying a handbag and like a pair of boots and like all these things that you're going to use primarily for your normal everyday life. It can be a little iffy. So I would just think of it like that. If it's for the business, then probably can write it off. If not, then no. Mm-hmm. And then I think something that goes overlooked is like the portion of your house that you use for your business can be written off as well. You can't write off your whole apartment because you're making music in your apartment, but if you have like a specific room or portion of a room that you're just specifically using to perform or record or whatnot, paint, you can write off that portion of your house. Wow. Different things like that. Or a vehicle, right? If you have a specific vehicle that's used for business purposes, then yeah, those things can be written off as well. Also like a website too. Website.
Okay, that's good to
marketing,
know. Okay.
Like if you were paying me to be here today, I would be a business expense for you, right? Okay. Stuff like that.
Oh, that's what I was thinking. Because I know on like Actors Access that sometimes transportation might not be paid for, and they're like, oh, like local hires only. And I know there's obviously a reason why they do that. Mm-hmm. But like if you live in like New Jersey and you might have to get like an Airbnb or like a hotel room or something like that to come to New York to do a gig, that could potentially be something written off.
Potentially. Yeah. I would talk to a CPA about that. I think it depends on your specific situation. And do you have to travel? Like could this be done from afar? Like if you're just traveling all around to have in-person meetings, it could be taken virtually.
Yeah.
It might, anything that's going to like flag the IRS to come and audit you, I would try not to do. But yeah, if there's a specific role and you have to go and travel for it, then the travel expense, could be written off. Travel expenses is like fair game for a write-off. Okay. So I would say like, depending on your specific situation, talk to your tax person, CPA, and see.
All right, cool. So do you have any resources, books, or speakers that you recommend for artists that need to sharpen their financial literacy? So I know we talked about I Will Teach You How to Be Rich.
Yes, that's a good one.
Such a good book. I'm going to link that. Yeah. Honestly, it's so good. But
I think if you have a non-financial background and you want to learn more, I think that's a really good book. I think A Random Walk Down Wall Street is a great book just explaining like the financial industry and how things work. He talks about money. He talks about how Wall Street works. It's a really good one. There's another book that was recommended to me. I haven't read it, but it's called Your Money or Your Life. Okay. And he does a lot. He explains a lot of sort of what we were talking about earlier about finding your joy and your enough, like what's enough for you, what do you want to spend your money on, and like how to sort of work backwards to fulfill that. I think that would be probably resonate with a lot of artists as well, because it's more like, using money as a tool to help you live your best life versus, strict math and calculations based, which I love because that's the whole point of money anyway, right? Is to use it as a tool to make your life better, and to improve your lifestyle versus, ruining your life and making you miserable.
Yeah. I think people should shift their relationship with money in a sense of like you said, making your money work for you and have it, create your lifestyle rather than allowing your money to be what defines your lifestyle. Yeah. Does that make sense? And have it define you and see it as a limiter rather than, like you said, a tool. Yeah. I'm going to link all the books that we mentioned in the description so everybody can grab them off of Amazon. And also, I would love for you to just talk about your business and what a one-on-one consultation would look like with you and what you do with your clients.
Yeah, happy to share. For those who missed it, I'll just shamelessly plug. It's Positive Money Project. But what I do is I offer one-on-one coaching. I'm actually also starting a group coaching program. My first ever group coaching program launching next month. So, for people who, might want individual coaching but don't have the funds for it, the group coaching program would be a really great option. And if you mention that you saw me on this podcast, I will give you a deal. But essentially my one-on-one coaching does a little bit of what we spoke about earlier. It's defining what your ideal goal, dream, future, perfect money scenario looks like. When do you want to retire? What are the things that are important in your life? What do you want to achieve? What's your trajectory? And then creating a whole money plan around that. Taking into account, obviously, the assets that you have now, the debts that you have now, what your cash flow looks like, your income versus expenses, and sort of just doing a whole full walkthrough of that. And then setting you up for what you should do in the future. For my longer term coaching programs, I will go through teaching sort of everything step by step, that we sort of did high level today. But everything from paying off debt, how to properly use credit, how to build up those assets, the accounts you should be opening, setting up sort of a long-term plan for your family, sort of your legacy building, wills, trusts, everything like that, making sure you have the right insurance in place, sort of just the whole gamut over the course of a few weeks. So just depending on which coaching program you're looking at, the goal is essentially to set you up or set my clients up for success by building that entire system with them. Teaching them how to do it themselves, how to make decisions when it comes to the accounts they need, the investments they should be making, and automating all of that so they can do what I mentioned before, which is hands off. I think about my money, during my weekly or my monthly money check-in with myself or with my spouse, and then it's running behind the scenes to make me wealthy one day.
Yeah.
So
nice.
It looks like.
Yeah. Well, thank you so much, Julie. I feel
thank
like
you
unclouded somebody's entire perspective on money with this episode. I'm so confident that
is literally my goal. That's why I started doing this. That's why I started my channel. So hopefully I did. And thank you so much for having me.
Yeah.
This was amazing.
Yes, of course. And thank you guys so much for tuning into this episode of Resources here on What's the Rate. And I'll see you on the next episode.